And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Two of the hottest trends in ETFs are cooling off a bit. Buying protection against the downturn in the market was the hottest trend of 2022 and into 2023. Investors owned stocks, but also sold calls that would collect income and provide a cushion against any downturn. But the market's been rising this year, so these strategies are underperforming. Another hot trend, buying the international market over the U.S. market, also underperforming. What's going on with all these strategies? Let's talk with Kim Arthur. He's the CEO of Main Management. Mike Akins is the ETF Action's founding partner. Kim, the big ETF winner last year was the JP Morgan Equity Premium ETF. That's JEPI, J-E-P-I. $27 billion in assets right now, and you've got one of the competitors, the Main Buy Right ETF, BUYW. They do similar things. They own stocks and sell calls against them, but both are underperforming this year. So when you're selling calls, you're betting the market's going to remain range-bound or lower. So, what's going on here? Why are we underperforming, and why are people continuing to pour money into these strategies?
Yeah, Bob, you nailed it. It's when you're selling calls, you're capping your upside. So obviously that works. The trade-off is to get an extra stream of income to protect you in a down tape like 2022, or in a flat tape, it works very well. But when you have an up 16% first half of the year, these types of strategies are going to underperform. I'm a big proponent, though, Bob. You want to set the expectation for each product or strategy that a client gets and then deliver on that. So if you set the messaging right, that 2 out of 3 that they'll do well, then you can kind of get through the difficult periods. But if you've told people that, hey, these things do well in all market environments, that's not the case. And the other thing that's happening now is, as the VIX has collapsed, you now have much smaller premiums that you are bringing in. So some of these strategies that tried to have double-digit type of distributions, those are unsustainable. You need to have something that is a level that you can do repeatably in all environments.
Mike, what is your take on buying protection, this kind of strategy? You noted to me that in a bull market, it's questionable if the juice you're getting from selling the calls is worth the squeeze. Explain that. It makes a lot of sense to me, actually.
Yeah. So, I think at the end of the day, you have a situation with these strategies where they're designed to provide a little less volatility and more income. So a specific set of investor that's looking for a particular outcome, these tools work really well. Oftentimes, however, especially after you come out of a bear market, albeit a short one that we just had, they start getting sold more as alpha tools or tools that can generate alpha, and that's just not the case. In almost all full market cycles, these types of strategies are going to have a much lower up capture ratio, and oftentimes a similar downside capture ratio. So over long time frames, for example, a standard call writing strategy on the S&P 500 would have an up capture of, say, 60%, and a down capture of 70%. That's great if you're looking for a specific, you understand those expectations, but in a bull market, you're going to fall. And as we know, the markets over time go up. So you are not going to keep up with the market with these types of strategies.
And the important thing is you're getting a premium here, of course, Kim. It's just not compensating you for the fact that the market's going up at the same time. So you're underperforming, essentially. That's what's going on. I just want to make sure our viewers understand what happens with these things.
Yeah, exactly. And another thing, Bob, I like to say that these have a place in people's portfolios, but it's a kind of glue between the wall, which is fixed income, investment grade. You're supposed to have downside protection. Last year it didn't happen. And they're supposed to live between that and the wallpaper, which is risk on equities. And if you look over an extended period of time, they do deliver in that bucket. It should be 6% type of returns, not equity returns, but better than fixed income.
Yeah. All right. I want to turn now to the other strategy that's sort of been underperforming as well this year, and that's international. And it all started out so promising, guys. Europe and emerging markets outperformed the United States very, very early on. A lot of people called for that to happen. It did. But it all basically faded. Look at these charts so far. I'm just looking at EFA, Europe, Australia, Far East, only up 8% this year. This is basically the global benchmark for ex-United States, the rest of the world ex-United States. Emerging markets, which is almost 30%, Hong Kong and China, also underperforming. And there's the S&P 500 up 15%. So the U.S. is far outperforming. And guys, as you know, this has been happening for a decade. But this was supposed to be the year. What happened? This was the year for international investing. All the cards were aligned in the right direction, at least, and it hasn't happened. Either one of you, go ahead.
So maybe I'll jump in there, Mike, and then you can come on there. So Bob, I think a couple things. I think one, the highest predicting factor for future performance of international stocks versus U.S. stocks is what the U.S. dollar does. And that period that you mentioned, from basically 2002 all the way up until up until 2022. Actually, it's 2011 to 2022. The dollar was in a straight bull market, so you were going to lose in international equities no matter what you did. The dollar topped. The dollar topped last September. Okay, so you really have to have an opinion on where the dollar is going. We personally think the dollar is heading down for various reasons. But I think the second thing that people need to make sure, don't confuse international equities with U.S. S&P. The S&P is over 60% growth. International equities are less than 40% growth. The comparable index here in the U.S. is large cap value. Large cap value is also just under 40%. If you look at that versus large cap value, it is outperforming year to date and on a trailing 12-month basis. So I think you need to make sure that the viewers know what they're looking for. You've mentioned plenty of times, Bob, you know, the S&P for the first half of the year was 8 stocks that drove it completely, and they were all growth stocks.
Yeah. So, Mike, does this make sense to you? I mean, the dollar story certainly makes sense. I'm not sure about comparing the rest of the world to the U.S. value. I mean, it's true. One of the reasons I think you can cite why Europe has underperformed is, for example, the German stock market has far fewer growth stocks in it than the U.S. stock market. That's certainly true. I guess you could call them value-oriented. Does that account for a big reason why we're seeing the underperformance?
Well, I think absolutely. I mean, you think about it from a multiples perspective. Look at the S&P 500 10 years ago, you know, first on a forward multiple basis on earnings versus today, the multiples expanded 20%. You look at EFA, you look at emerging markets, they're basically the exact same. And what's also interesting is they're actually the exact same if you look at the equal weight S&P 500 index. So it's not just international, it comes back to those FANG plus stocks, right? You have this situation where the market continues to get led by mega cap names, primarily mega cap technology or tech-like names. And in that, the big difference in returns over this past decade has been multiple expansion. You've seen no multiple expansion anywhere outside of the mega cap indexes. And I think that is the primary reason behind this. And then, of course, it just feeds on itself. If you look at just flows of the marketplace, you see more and more flows continuing to go into U.S. stocks, U.S. ETFs, which leads to U.S. stocks, where very little money is going into the international marketplace. And then it kind of just creates itself. I'm not sure what the catalyst is there, other than to say that it has to start with those big names: Microsoft, Apple, Amazon, Tesla now, Google. Those names that are creating this multiple expansion for the broader S&P 500 because they make up such a large percentage of it. That's where the catalyst will have to be to see value come back, to see international come back, to see emerging come back.
The problem is, all three of us sort of grew up in the last 20, 30 years with research that indicated that long-term value tended to outperform growth, and long-term, small cap tended to outperform big caps. This is well-known research, goes back into the 1990s and even before, and yet it's been over a decade now where this has not really happened. So it's a little... something kind of has to give. Either there's been a paradigm shift of some kind. I mean, 10, 12 years, since 2010, essentially, is a long time. You can't say, well, you have to wait for 25 years for something to work. 12 years is a long time, and yet still, growth outperforms value, large cap outperforms small cap.
Yeah, I think, if you look at...
You do get... Oh, sorry. You do get, like, going back to the mid 70s. This is only, if it were to persist here, would be the sixth time that international would outperform the U.S. So they are long periods of in between. They're brief periods that usually are less than 4 years in duration when international does outperform. And again, that's what I go back with the U.S. dollar. That's the biggest predictor there. And right now, the U.S. dollar is 10% off its top. You look at, we are way ahead of the rest of the world in terms of fighting inflation. Our inflation numbers are lower than the rest of the world. Our interest rates are higher than the rest of the world. So what does that mean? That's a perfect setup where we're going to be cutting rates before the rest of the world. And that differential leads to a stronger dollar. And I would just reiterate, I don't mean to beat a dead horse, but you can't underappreciate the fact that it's just like here in the U.S., if I'm a value investor, then I know it's because I've got 40% growth in my strategies. But if I'm a growth investor, I better have strategies that have 60+% if I'm going to keep up with the other growth indices.
Yeah. Mike, did you want to say something?
Yeah, I mean, I just say, I graduated college in '99, and I've been in the markets pretty much since I graduated. And I would still note that I have benefited from being in small cap stocks, right? I mean, I think we lose sight of the fact, just going back to 2000, the small cap index, the S&P small cap index, has trounced the S&P 500 in that time frame. So in my investing life cycle, it's just getting harder and harder to remember that alpha that was delivered in that first part of that life cycle. And so I think to Kim's point,
and you're talking about the S&P. You're talking about the S&P small cap, the 600, right? Not the Russell 2000, because those are different indexes, right? To a certain extent,
they are very different indexes. Yes, I think you have to. I like to look at the S&P, but as long as you keep it Russell to Russell or S&P to S&P, you get similar results over those full market cycles. But yeah, I think the point being to reiterate Kim's point is that they can last in long cycles, and when it turns, it can turn very, very quickly. So it's painful right now. That diversification is real, and it's hard to stay the course. But ultimately, I think the long-term data proves out the benefit of being value, being international, being small.
We're all heading towards retirement on the long-term data. That's, I think, the problem. Kim, the other big story this year is how many active managers are jumping on the ETF bandwagon. BlackRock has, I think, 18 now active mutual fund managers jumping to ETF conversions. Fidelity is also jumping in. Now, some of these are replacing actively managed mutual funds. Some are in addition to mutual funds. Kim, you're one of the true believers of ETFs. You manage, what, $2.7 billion in assets? It's all in ETFs. Where is all of this going? I mean, to me, this just looks like just another nail in the coffin of the mutual fund industry, because the money, people keep saying, aha, I see active's working, but it's coming out of active mutual funds into active ETFs. It's not coming out of passive ETFs into active, at least to any great extent that I see. So I keep going to the point about the long, slow death of the mutual fund industry.
Yeah, and I think Mike's got some great data on this that he can opine on. But I would point out, last year, 2022, again, was another nail in the coffin of mutual funds, where growth mutual funds gave you a negative return, and they went ahead and distributed a gain to you because of all the outflows that happened. And the way the wrapper works, you got nailed on both sides. That hadn't happened since 2008, so it was a painful reminder. And you're exactly right, Bob, that what is happening is active ETFs are replacing more expensive mutual funds, so you get a cheaper wrapper and you get the tax aware coming out of it. So we've got 4 of those active ETFs, and again, I said, Mike's got some great data on the growth in that area, but they're better constructed and more tax aware.
Mike, you want to weigh in on this? I mean, would you agree with me? Everybody, I always get these active managers that say, aha, you see, the ETF industry is finally catching on to active management, but it's at the expense of the active mutual fund industry, not passive ETFs. They're going from active mutual funds into active ETFs, not out of passive. They seem to think some victory is being had here. It's just money sort of moving around from mutual funds to ETFs.
Definitely a big part of the whole game is the conversion and the transfer of mutual fund to ETF assets. That's why no matter what market we're in, ETFs over the last 2 decades have seen steady, powerful growth is because you're continuing to see more and more as required minimum distributions come out of mutual funds, they flow into ETFs and taxable accounts. And that's for obvious reasons. Kim pointed out the tax efficiency, you just can't beat it. But I think there's another word that we're forgetting here, and that's transparency, right? So I'm actually a little more bullish on active ETFs now, albeit active with some asterisks, right? So DFA is active, but DFA is active where I would think of it more like I think of a factor strategy with an index or a smart beta strategy, even though I don't like that term, right? So, but the transparency of the portfolio is also huge because more and more assets is being controlled by firms like Maine. You know, Maine was a leader in taking this idea of tactical allocation using ETFs because they're so tax efficient, because they're so transparent. You can build very powerful models for your clients using your macro research, your company's assumptions to build these portfolios, and that transparency factor is huge. ETFs, I guarantee you that Kim and his team can log in every day and they can look right through the ETF holdings into the individual companies and they know what their portfolios look like.
Right.
And that's a huge thing that we're seeing, I think, in addition is, everybody talked about the non-transparent wrapper. That's not happening. Active transparent is happening.
I want to hit one other hot topic right now, Mike, or Kim, you can weigh in too. Avoiding losses. This has sort of been a growth industry in the last year, in addition to buying protection here and selling stocks and going out and buying calls. Another hot ETF product are the buffered products. So they're slightly different. Those of you who don't know about it, they avoid losses up to a stated amount. And once you go through the floor, then it's sort of you follow the benchmark. BlackRock's iShares launched a couple new buffer products recently. Mike, can you explain how these work? And it's sort of the same idea, buying some kind of protection at this point.
Absolutely. I mean, buffer strategies, these types of strategies have been around for a long time outside of the ETF world, where you're providing a certain amount of protection to the first set of downside. That's why all these buffer ETFs have a name in it, right? Like the Power 9 or the Power 20, because that 9 refers to we're going to protect you for the first 9% of losses. So you're not going to experience that loss on the S&P, but once you go through it, you're going to keep going through it. And obviously the growth, the timing of the launch of these in the ETF market couldn't have been better, right? Timing is everything in the ETF world. It came into kind of that first volatile marketplace that we've had in 10 years. We had a bear market, and these strategies delivered as long as you know how to use them. What I mean by that, Innovator ETFs does a really good job explaining it on their website, providing the right data. But you have to understand that once you go through that buffer, that cap, that loss protection, you're now going to start tracking whatever your reference index is one for one. And so you need to be active with this. And the good news is the data proves out that the investors are. If you look at the flows, we've gone from 0 to 20 billion. The money is going to the front month of the resets of these products.
Yeah. And Kim, the one thing, again, I noticed is money keeps pouring into these kinds of strategies. Even though we're in an up market, people seem to have this sense that the rally is very fragile. There's a lot of naysayers still out there, I think, and that's why these products still attract money.
Well, yeah, to that point, Bob, think about the strategists for Wall Street as a whole for the second half of the year. Their target price is negative 5% from the last, from the end of the June quarter. So you are right. I would also point out that, as Mike said, you have to. I go back to the promise that you're supposed to make clients is that we're going to deliver this expectation for the strategy or product, and then you need to deliver on that. You need to deliver just on your expectation. It's very, very difficult for these buffers to actually deliver for the average investor because there's so much timing involved. And I just look quickly at First Trust's D-Deck. So David, Edward, Charlie, that's their oldest ones. They've been out for almost 4 years. They don't tell you to buy and hold, but if you were to buy and hold it, you were up 4. The S&P was up 11% over that period. Not so good. How about for periods like 2021 when the tape was running and you were supposed to be capped at up 15%? You were up 8 and the S&P was up 29. Okay, how about 2021? You're supposed to be, or 2022, you're supposed to be down, like only 5 because you're protected on the down 5 to 30. Well, you were down 7. That's because there's a wrapper expense, there's some slippage. So again, it's really, really tough to deliver on the expectation, and those prospectuses are thick.
Yeah, and even these things, the Jack Bogle in me kind of gets all up about this, that you're still doing market timing of some kind, and Jack always wagged his tail. You know, you can't do that successfully in the long run, guys. One of the precepts on which Jack lived for many, many years. This has been a fascinating discussion, guys, a good overview of the overall market. I'm going to have to leave it there. That does it for this week's ETF Edge. My thanks to Mike and Kim. We've asked Mike to stick around and offer us more observations on ETF trends coming up. That's the ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.